The year is 1907. It is just past noon on Wall Street, and a crowd is forming. Not of traders, but of ordinary citizens. They are not buying stocks. They are demanding their money back. Inside a small bank office, clerks scramble as withdrawal requests pile up faster than they can be processed. The panic is spreading, not because people understand the financial system, but because they don't trust it. And trust, as it turns out, is the only thing holding it together. In another building across the city, one man is quietly orchestrating a rescue. J.P. Morgan. He summons bankers into his private library and locks the doors. No one leaves until they agree to inject capital. It works, but barely. This moment raises a question that still defines modern finance. How can a system built on confidence survive when confidence disappears? This is not just a story about banks or markets. It is the story of a financial architecture that evolved through crisis, improvisation, and unintended consequences, and how each solution planted the seeds of the next failure. To understand the financial history of the United States is to understand a machine that was never fully designed, only repeatedly repaired. In the beginning, there is no system, only a problem. After independence, the United States is financially fragmented. States issue their own currencies. Debt from the Revolutionary War lingers. Trade is inefficient, and trust between institutions is minimal. The economy functions, but barely. Enter Alexander Hamilton. His solution is radical for its time: centralize financial power. He proposes a national bank, a single institution that can stabilize currency, manage debt, and impose order on chaos. Imagine dozens of people trading different currencies at a market. Now replace that confusion with a single trusted medium. That is the promise of centralized finance. The first bank of the United States is born. It works until it doesn't. Political resistance grows. Power concentrated in one institution begins to look less like stability and more like control. The bank's charter is not renewed. The system fragments again. This cycle, innovation followed by backlash, becomes a recurring pattern. As the 19th century unfolds, banks multiply, but regulation does not. Each institution operates with its own standards, its own risks, and its own vulnerabilities. Credit expands rapidly. Railroads are financed. Industry grows. But beneath the surface, the system is fragile. The mechanism is deceptively simple. Banks take deposits and lend them out, but they don't keep all deposits in reserve. This is called fractional reserve banking. It works as long as not everyone demands their money at once. But if they do, the system collapses instantly. This is the central paradox. The very mechanism that fuels economic growth also creates systemic fragility. By the early 20th century, this fragility becomes impossible to ignore. The panic of 1907, it is the result of a system with no central backstop. There is no lender of last resort, no institution responsible for stabilizing the entire network. The solution arrives in 1913 with the creation of the Federal Reserve. Its purpose is clear: provide liquidity during crises, regulate banks, and act as the system's shock absorber. Think of it as installing a circuit breaker. When pressure builds, it prevents total collapse. For decades, this system appears to work, but then comes 1929. The stock market crashes, banks fail, unemployment surges. The Great Depression is not just a market event, it is a systemic failure. The flaw is not in one institution, but in the assumptions underpinning the entire system. Markets were believed to be self-correcting. They were not. In response, regulation tightens. The Glass-Steagall Act separates commercial banking from investment banking. Risk is compartmentalized. Stability returns. But stability comes at a cost: slower growth, less innovation. By the late 20th century, pressure builds to remove these constraints. Financial markets evolve. New instruments emerge: derivatives, mortgage-backed securities, complex financial products designed to distribute risk. At first, the logic is compelling. Imagine taking thousands of home loans and bundling them together. By pooling risk, the system becomes more resilient. A single default does not matter. Risk is spread across investors. This is the genesis of securitization. But here lies the hidden flaw: the assumption that risk is reduced simply because it is distributed. In reality, it is obscured. The mechanism becomes increasingly complex. Banks originate loans, sell them to financial institutions, which package them into securities, which are then sold to investors globally. Each step removes accountability from the original decision. The person issuing the loan no longer bears the risk of default. This creates a perverse incentive. Loans are issued not based on quality, but on volume. By the early 2000s, this machine is operating at full speed. Housing prices rise, credit expands, confidence grows. Then comes the catalyst: housing prices stop rising. It is a small shift, but in a system built on assumptions of perpetual growth, it is catastrophic. Defaults begin. The securities tied to these mortgages lose value, but no one knows exactly where the risk is concentrated. The system, designed to distribute risk, has made it invisible. In 2008, the collapse becomes undeniable. Lehman Brothers files for bankruptcy. Credit markets freeze. Institutions stop trusting each other. The algorithm processed trillions in seconds. The economic recovery takes years. Again, the system adapts. Regulations increase. Capital requirements rise. Stress tests are introduced. The financial system becomes more resilient, but also more complex. And complexity introduces a new kind of risk. Today, the architecture of finance looks different, but the underlying principles remain the same. Leverage, liquidity, and trust. Take ETFs. They promise instant liquidity. But the underlying assets may not be liquid. In a crisis, this mismatch can create stress, much like a bank run. Or consider private equity. Capital is locked away for years, reducing short-term volatility. But this also obscures true market value, delaying the recognition of losses. Crypto markets push this even further, removing centralized oversight entirely. The promise is decentralization. The risk is the absence of a stabilizing authority. The pattern is consistent. Every innovation solves a problem, but introduces a new vulnerability. To understand this system, you need a framework. First, identify the promise. What inefficiency is being solved? Faster transactions? Better risk distribution? Higher returns? Second, examine the mechanism. How does money actually move? Who bears the risk at each step? Third, locate the assumption. What must be true for the system to work? Continuous growth? Stable prices? Infinite liquidity? Finally, ask the critical question. What happens if that assumption fails? Because it always does. The financial history of the United States is not a linear progression toward perfection. It is a cycle of creation, expansion, failure, and reform. Each generation builds a more sophisticated system, one that appears safer, more efficient, more rational. But beneath that sophistication lies the same fundamental truth. Finance is not built on certainty. It is built on belief. And belief, once broken, is the most difficult thing to restore. So when we return to that crowded street in 1907, to those depositors demanding their money, we see something familiar. Not an isolated panic, but a recurring pattern. The faces change. The instruments evolve. The scale increases. But the underlying question remains unchanged. Can a system designed to manage risk ever fully understand the risks it creates? The answer, history suggests, is no. And that is not a failure of individuals. It is a feature of the system itself. Understanding this is not about predicting the next crisis. It is about recognizing the structure, the hidden connections, the feedback loops, the assumptions that quietly shape outcomes. Because once you see the system clearly, you stop asking whether another crisis will happen. You start asking when and why.